Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we will explore how to start scalping trading, a technique that allows you to take advantage of small price movements for quick profits. You will learn what scalping is, the key elements that makes it work, and a step-by-step strategy designed specifically for beginners. Make sure to watch until the end to fully understand how to apply this approach effectively and manage risks involved. Now, what is scalping trading? Scalping trading is a method that focuses on making small trades throughout the trading day. Your goal is to capture small price changes rather than waiting for larger moves. This means you enter and exit the market quickly, often holding positions for just few seconds or few minutes using the 1 minute time frame or the 5 minutes time frame as the case may be. You do this because small price movement happens frequently, especially in liquid markets like Forex or popular stocks. By making many trades, you aim to add up those small gains into a meaningful profit over time. For scalping to work, you will need to pick markets with good liquidity, enough volatility, or price moves fast but doesn't become unpredictable with low spreads. This allows you to enter and exit markets easily without big price gaps. Now, the key to scalping is using tools that help identify when these small price movements are likely to occur. You use common indicators which might include the moving average, which will help you to see the trend direction quickly. You can also make use of the Bollinger Band to spot when price might bounce, and you can also make use of your relative strength index (RSI), which shows if the market is overbought or oversold. For example, moving average can tell you if the price is trending up or down by showing if the short-term moving averages crosses above or below the longer-term moving average. You can use this as a signal to enter a trade in the direction of your market. It's important to understand that scalping requires sharp focus and discipline. Since trade happens quickly, you must act decisively and stick to your plan without hesitation. The rapid pace means emotional control is critical to avoid costly mistakes. Step-by-step trading strategy for beginners to start scalping. Let's see the step-by-step we can use. Now, the scalping trading requires a clear and disciplined approach to identify and capture small profitable moves. So let's look at the step-by-step process we can use. The first step would be the market and time frame selection. You would have to choose the market with high liquidity and tight spreads such as major forex pairs or highly traded cryptocurrency pairs. Liquidity ensures you can enter and exit your position quickly without slippage. You are going to also make use of your 1 minute or your 5 minute chart to capture small price movement effectively. So you have to focus mainly on your London section and your New York section when the volume and volatility is at its peak. You have to notice price moves smoothly and quickly at this time frame. You can see the 1 minute time frame, see how fast price is moving up and down. This is how we can capitalize on this particular 1 minute time frame using this strategy. It will help us to capture the high liquidity and help us enter and exit trade with minimal delay. The second step would be to set up your chart with indicator. You set up your indicator, you use two indicators. The two indicators we are going to make use of your EMA. You set up your EMA to 5 period EMA and 20 period EMA. This is the two EMA we will use. We would also make use of our relative strength index. We set our relative strength index to 14 period. It has to be at the 14 period relative strength index to confirm momentum. You have to keep your display clean, remove all other overlays to focus on price and these core signals. So these are what we are going to focus on, these two indicators, the moving average and this RSI. The third step would be to enter a long position when you notice your 5 period moving average, the blue line, which is your short period moving average, crosses over your 20 period EMA, which is our long period moving average. Once we see a crossover, we enter a buy trade at that area. We place our stop loss just beyond the most recent swing low or the most recent swing high in a sell trade. In a buy trade, you place it below the most recent swing low and you aim for a profit target of 1:1 or 1:2 at a stop distance to maintain a balanced risk to reward ratio. Now let's see an example. We can see at this area in the market, we can see price crossed above our our long term simple move exponential moving average. The blue line crossed above the yellow line. This signals our buy trade, and as we can see our EMA, we can see that our RSI shows that we are heading to the buy direction because price was trading above our 50 region. So at that area, you would want to enter a long position. You put your stop loss just below the most recent swing low in that area and you aim for 1:2. Once price gets to your area and touches your take profit, you leave the trade and you look for another opportunity. This is as simple as it gets. The crossover triggers the entry here and you just need to notice that the stop loss just sits below the most recent swing low and the target is twice from our distance. This is how the strategy is. Now the fourth step would be risk management and position sizing. Now you have to risk no more than 1% of your trading account on a single trade. So you need to calculate your position size with a position size calculator, or you make use of your position size. To get your position size, you make use of your account balance times the percentage risk you want to risk divided by your stop loss distance. This formula adjusts your loss size so a one stop loss move would cause the same percentage regardless of the volatility. Also set a daily loss limit to prevent emotional decision making after strings of losses. So your daily stop limit, you can decide that you would want to take a maximum of just 3% of your account loss. You want to just take 3 losses in a day and you're out of the market, or you can decide you just want to take 3% of your account loss. That should be the maximum mark loss in a day for you, meaning you can risk 0.5% of your account per trade to have 6 trading opportunities. This is just to help you to be disciplined and not to help you to avoid revenge trading in the market. Now with a 1% risk and a 5 pip stop, your lot size adjusts automatically to protect your capital. The fifth step is to practice this particular strategy on a demo account. You have to simulate this strategy in a demo environment before executing live. And when you are practicing this, you need to record every trade entry and exit and outcome so that you can backtest across different sections and market condition to verify consistency. Now only switch to a funded account once you have achieved stability and repeatable results in this demo account. Now the sixth step would be emotional control and discipline. Scalping requires intense focus and strict rule following. Never deviate from your entry and exit criterias. Limit the number of trade per session to avoid fatigue and poor decision. You have to take scheduled breaks to maintain clarity and avoid burnout, because we are trading on the 1 minute time frame. It is moving so fast. You need to be focused and avoid over trading. The seventh step would be to keep a detailed trading journal. You have to log every single trade setup, entry, exit and result, and your mental state in your trading journal. This would help you to review this journal weekly to identify recurring mistakes or avoid making the same mistakes over and over again. This practice turns isolated trade into actionable insight for continual improvement. It will help you to spot repeatable patterns and avoid bad patterns. So journaling of trade is very important in the forex market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching and I will see you in the next video.